Chapter 5, Property Transactions, Capital Gains and Losses. These are some of the taxpayer issues that need to be looked at or that will play into how you're going to report for tax purposes property transactions. Is there a realized gain or loss? Is there a recognized gain or loss? What is the character of the recognized gain or loss? So is it a capital gain? Is it a normal, ordinary income? What is the carryover basis to the assets received? This is going to determine gain or loss or help you determine that. What is the holding period? That's going to go to the character of the gain or loss and help you decide whether it's a long-term or short-term, man, I can't talk today, short-term gain or loss, and that will have tax consequences. So generally, a sale or exchange of capital assets will result in a recognized capital gain or loss. So if it's a capital asset and you have a gain or loss, that's going to be generally a recognized capital gain or loss. Then, depending on how long the holding period of the property has been, you will designate it either a short term if it's less than a year or equal to a year that you've had the asset, or a long-term gain or loss, capital gain or loss, based on if it was for over a year. So basically, you'll categorize gains and losses as either short-term capital or long-term capital, and you'll get the net total. So for long-term capital, you'll combine gains and losses, see what those net together to be. For short-term, you'll net them together and see what that is. And then the long-term capital gains, you get a favorable tax rate when you're taxed on those, sometimes even taxed at a 0% rate on those. And then long-term capital losses, we'll talk about the carryover, carryback rules for those, but you are allowed to count $3,000 worth of a long-term capital loss against your ordinary income. So normally, and for the rest of a long-term capital loss, it will have to be netted against some type of long-term capital gain in order to use the tax benefit of it, but you are able to use $3,000 worth to net against your ordinary income. And again, for policy reasons, the whole reason that we talk about capital gains and losses and tax them differently and all of that is to encourage, for policy reasons, it's to encourage people to invest their money rather than to just sit on it and not take risks, not invest the money. So we're saying, hey, if you take risks, if you're willing to invest this money and you make money with it, we will tax you at a lower rate. So just the calculation for realized gain or loss generally is just whatever the amount that you got on the transaction minus whatever your adjusted basis is. So obviously, you're not going to be taxed for your the basis that you have in the asset, which the starting point for that is generally how much you paid for the asset. So obviously, this is just a way that the tax code puts out there to give you back what you paid for it, so you're not basically being taxed on it twice on that money. So generally, an adjusted basis starts with the initial basis whenever you received the asset, whether that was by gift or by purchase or whatever. So whatever the basis that you had on the asset initially, plus any capital additions, so additions to the asset that would be considered capital additions, minus any capital recovery. So this is any recovery of your basis, and that's going to depend a lot on what type of asset it is, whether that's even possible. But this is just the general equation. Initial basis plus capital additions minus capital recoveries gives you your adjusted basis. Okay, and then determining whether there has been a realized gain or loss. And again, this isn't the end of the equation because we don't only want to know if it's a realized gain or loss, we then will want to know whether we are going to, for tax purposes, recognize a gain or loss on the transaction. Before I get too much farther in here, I think I've mentioned this before, but it's worth it to mention that this idea of gains and losses, short-term, long-term, capital, ordinary, etc., it's a pretty complex concept. And we won't dive too deep into the nitty-gritty details of that in this class. But I may have mentioned before, in doing my graduate tax work, actually took an entire class that was nothing but talking about these type. I think the class was called Property Transactions. So if you can imagine an entire semester just dedicated to this, that gives you some idea that this, yes, could be a much more in-depth and complex topic. But anyway, this slide here is just a flow chart that helps you to calculate during a transaction whether there should be a realized gain or loss, and then again that will be the starting point to determine whether you have a recognized gain or loss. And this graphic just shows you that a realized gain or loss will encompass everything that is a recognized gain or loss, but also encompasses a little bit more than that. So there will be some items that are realized gains or losses, and obviously for tax purposes we only really care about a realized gain, of course, because we're not going to be taxed on a loss. But you may have a realized gain in several instances and not be taxed on that. Okay? But everything that you are taxed on that's considered a recognized gain would obviously first be considered a realized gain. So a recognized gain or loss is just the amount that's actually reported on the tax return. So again, just like that previous graphic showed you, the total amount of recognized gains and losses, or the total incidence of recognized gain and loss, is going to be less than, or at most equal to, realized gains and losses. And then realized gains and losses is just going to be anything that's specifically kept out or limited based on provisions in the tax code and in tax law in general that don't force you to recognize that gain or loss. And just to note, this bottom bullet point, losses on non-trade or business property are generally not considered deductible. Okay, so let's talk a little bit about basis. These are some considerations, some areas that may affect basis. For instance, cost basis would be cash plus fair market value of any property given to you in the exchange. So, it's if you paid for an item plus gave some of your property in order to exchange for another capital asset, then you would add the fair market value of the property given. Okay. You also add to that shipping, installation, insurance, and transit, Section 263 UNICAP items, which we'll cover later, and any construction loan interest. Identification issues. This is just kind of a detail to throw out at you, but if the capital asset that we're talking about is stock, obviously stock prices fluctuate, so you may end up owning thousands of shares of stock in a company, and then to be able to determine, let's say at a later date that you sell some of those shares, you're going to want to be able to determine which of those shares you sold. Because some of those are going to have a lower basis than others because you ended up paying less money for some than other shares of that same stock. So the general rule is first in, first out when determining what your basis is in stock, unless it's specifically identified. So if there's like numbers or some other identifier on the shares of stock, and you can say, hey, I specifically sold this last share that I bought, then you can say, okay, we'll use that cost as the basis. But if there's if they're completely identical, it's just a computer transaction, and you say, okay, I went from having 10,000 shares to 9,000 shares, we're going to assume that the 1,000 shares you sold are going to be the first 1,000 that you had purchased. So here's a flow chart that you can walk through to determine a donee's basis in gift property. This is the recipient of a gift. So you start with, is the fair market value of gifted property less then the giftor or the person giving the gifts, the donor's adjusted basis. If it's less, then you move to the right. If no, you move down. And other than just keeping track of which is the donor and which is the donee, it's a pretty straightforward flow chart there. This slide is just showing from the, this is the donor or the person giving the gift. So if the gift tax paid where fair market value is greater than the donor's adjusted basis, then the gift tax, a certain amount of that is added to the adjusted basis of the donor. Okay, so you have gift tax paid times the fair market value at the time of the gift minus the donor's adjusted basis divided by the gift minus the annual exclusion. Okay, so for 2015 tax year, which would be the taxes that we do starting January 1 for the previous year, that exclusion is $14,000 per person, and that can fluctuate, so obviously that's something you'd want to look up. But that's the basic equation, and we'll talk more about the gift tax later, but that is the basic equation that you would look at if you were the gift giver and paid this tax. You would add that to the adjusted basis, and then obviously if you look back here, the donor's adjusted basis does come into determining what the donee's basis is in the property. So that is an issue to take a look at. When you are receiving property from someone who's died, we call someone who's died and gifted you property through their will or through whatever mechanism, we call the person that died the decedent. The general rule is that the recipient's basis is fair market value at the date of the giver's death, or assuming that there for some reason is an alternative valuation date, that would be at the fair market value as of that alternative valuation date. 2010 was a pretty funky year in taxes, so you would just make a note that if the decedent died in 2010, and obviously, you know, most of those, at least from a gift tax point of view, most of gifts given by a decedent who died in 2010 have already played out in the tax laws. But there are special provisions because of some of the tax laws that expired and aged out in 2010. That was a special year for gift taxes. And then finally, if a married decedent lived in a community property state, their surviving spouse automatically gets a stepped-up basis in his or her one-half of the property as well as the decedent's one-half. So basically, you live in a community property state, the surviving spouse, basically as of the date of the death, a stepped-up basis just means you're going to look at the fair market value when this event happened. So if a surviving spouse dies, half of the property that is in that person's will or goes into, assuming that the decedent dies intestate or doesn't have a will, whatever their portion of the property that's allocated to them is stepped up. So the fair market value changes, or the adjusted basis changes to the fair market value at that time. And this just lets you know that it also changes for the living spouse at that same time. So something to keep in mind there. And obviously, community property states are the heavy minority, but if you practiced in one of those states, obviously you would pay more attention to these rules. Converting personal use property to business use. So for business purposes, the basis is the lower of fair market value on date of conversion or the owner's adjusted basis on that same date. If the fair market value is less than the donor's basis whenever the property is converted, then fair market value less depreciation is used to calculate the loss, and the owner's adjusted basis on the date of conversion will be used to calculate gain. And both of those are less depreciation taken. So we can take a look at this flow chart. When we are determining how basis is allocated, assuming that there's a basket purchase, and that just means more than one item goes into this purchase. How are we going to allocate? This is usually, like if we're looking at land and building, or whatever it is we're looking at, where it's not specifically set out and stated what the purchase price is for each particular part of the purchase. So step one is determining the total purchase price, and that's determined by cost plus outlays, or money that's paid for placing the asset in service. Then step two is determining the fair market value of each asset purchased. This may have to be done through getting some type of professional valuation done, assuming that this is not, there's not like a ready market for this specific asset. And then you're going to multiply, you're basically going to use the fair market value of each portions, each separate part of the basket, and that's going to become your ratio for allocating the basis for that item. So you would add the total fair market value of each asset purchased, and then whatever percentage of that total each asset makes up, that would be the ratio that you would apply to the amount from step one. So non-taxable stock dividends. Non-taxable stock dividend is allocated a portion of the basis from the stock upon which the dividend was issued, and then the new basis for per share for all shares is the total basis divided by the number of shares now owned by the taxpayer. So you're basically just reallocating the original basis to all of the shares. So then sometimes you're going to have non-taxable stock rights. So this would be like the right to purchase more stock, options, that type of thing. So if the fair market value of the rights, the options, or whatever is less than 15% of the fair market value of the stock, then the basis of the rights is 0. However, if it's greater than 15% of the fair market value of the stock, then you kind of do the same thing that you would do with stock dividend, where you basically take the overall basis and you reallocate the overall basis in the current stock that you hold between the proportionate value, fair market value of the stock versus the options that you have. I know that can be kind of confusing, but just getting the basic idea of it is enough to allow you to know, okay, there's certain threshold numbers here when dealing with fair market value of stock or stock rights or the options that you may have, and just knowing that 15% threshold, or that it's around there, you could then just go up and look up whatever you need to see there. If the rights expire before being used, then you basically just reverse the reallocation that you did. If they're exercised, then the basis of rights is added to the cost basis of the stock, regardless of the percentage of fair market values, like we already talked about. And then if the rights are sold, whatever basis you had based on this concept would be used to determine the gain or loss. Now, when we're talking about determining what type of property is a capital asset, we would look to section 1221, and it sets these various exceptions out for what is considered a capital asset. So you've got inventory, section 1231 assets, accounts receivable, supplies, letters, copyrights, and literary, musical, or artistic compositions. So anything that is not one of those things would be considered a capital asset, and so would receive the treatment that we've talked about throughout this chapter. So this exception exists for this literary, musical, or artistic composition. The taxpayer who created the property may now make an election to treat its sale or exchange as capital. So those are just for self-created musical works. So you see that as an exception there, but there's an exception to the exception. Section 1231 property includes trade or business property that is subject to depreciation and real property used in a trade or business. So again, that was one of the exceptions to property considered a capital asset. Just part of the 1231 designation, and again, if you get into actually doing taxes and you run across this a lot, people say, oh, it's 1231 property. This is one of those things that you would just come to know just through using it in conversation or whatnot when dealing with this type of stuff. But again, you may end up having to go back and look at specific provisions within 1231 to determine specific issues that you want to take a look at. But any gain recognized on the sale of a 1231 property may be subject to depreciation recapture. And this will basically convert part of the gain from capital in nature to ordinary income, depending on the amount of depreciation that has been recognized. And again, we will talk more about that as we move through the semester. I don't want to get too much into the details of these other provisions that govern capital gain and loss just yet, but this may be a handy reference slide later on when we look at these in more detail. This slide's important though. This slide kind of gives you the idea and kind of the some help in understanding why this could be viewed as a policy decision to encourage investment, because long-term, in general, long-term capital gains are taxed at either the 0%, 15%, or 20% tax rates. And you fit into one of those three categories based on what your AGI is. So for people with a lower AGI, 0%, for people with kind of a middle range AGI, 15%, and for people in the highest brackets, 20%. But keep in mind that generally the people in the highest brackets that are getting that 20% rate are looking at rates above 35% on their normal taxes. So that's still, it's not 0%, but it's still a substantial savings over what the normal tax rate would be on that money. So, you know, that is a substantial savings. But even for some of these other types of capital gains and losses, unrecaptured Section 1250 gain, again, I don't really care that you know what the sections say at this point in time. Just being able to say, okay, if 1202 comes up in a question, then I know I need to look that up, and I know that that carries a higher capital gain tax rate. But even those can end up being substantial savings, even though they're higher than normal long-term capital gain rates. So this is just a look at what the form looks like for qualified dividends and capital gains, the worksheet used to help you figure line 44 on the 1040. This is just the netting of gains and loss by long-term or short-term. We talked about that already. A little bit of a flow chart there. pretty self-explanatory, but you can take a look at that process there. And, I would recommend just having those slides available to you and also using this flowchart here to help you determine how to net those all together and the steps that should be taken when determining what realized capital gain and loss is for individuals and how that will be taxed and what parts of the 1040 that's going to go to.